Hello, this is Brian Shannon from AlphaTrends.net. Today is Monday, the 15th of September, 2008, and the market closed. I'd taken a couple days off last Thursday and Friday as we saw a rally within this primary downtrend, which continued to show a pattern of lower highs and lower lows. And today, obviously, we had some news amongst the financials again, and that group continues to weigh on not only the financial sector and the S&P, but throughout this whole market as we're seemingly at a point where people are just giving their stocks up right now. The market is at a new closing low for the year, and if we take a look at a weekly time frame, you can see that the last time the market closed at these levels was actually back in late 2005, right over in here. So we've given up basically the bulk of the gains from the 2004 lows, and if we look at these lows, of course, we're still, some people are in a winning position, but it goes to show that risk management continues and always will be job number one. If we take a look at the lows from 2002 and draw some Fibonacci on there, what we had seen is the first real panic sell-off found support at about that 38.2% retracement level, or about 126.5 right here. If we take it down to a 50% retracement, it would indicate about 117 and a quarter or so, and obviously that, at today's pace, that's just we should see that this week, possibly tomorrow. Someone did ask over the weekend if I could take a look at a longer term picture using the VWAP, and what I'll do is just take a look at 300 weeks, and unfortunately that changed my scaling, so let me figure this scaling out, snap it back to the window. If we take a look at the VWAP on this S&P 500 and we draw it backwards towards the left, you can see that basically anyone who bought since 2002 remains underwater. Now, I think that actually that doesn't paint the exact picture, because trading volumes are so large here in the SPY since basically beginning of 2007 or so that things changed when we came out with the double long and the double short. The SSO is the double long spiders, and the SDS being the double short spiders. So obviously the SDS is breaking out what looks like a cup and handle in here, as we see that this prior level not quite broken out yet, but looking like clearly it remains in an uptrend, which is of course going to be the opposite of what we see on the SPY, which is showing this pattern of lower highs and lower lows on basically any time frame you look at. So here we see 200 weeks worth of data, and again, clearly we see the pattern of lower highs and lower lows, and from an investor's standpoint, as long as that weekly time, the weekly 40-week moving average or the 200-day moving average is trending lower, that's what I define as a bear market. I made that clear in my book, and that's what I said back in a video in November, December of last year. Of course, there's been some great rallies, and there will continue to be great rallies, but don't look at this as the capitulation low. We still have a lot of uncertainty out there and a lot of indecision, and it's going to take a lot of time to heal these deep, this deep of a badly wounded market. Where again the support may lie, we could use those longer term Fibonacci, but right now it just seems like a free fall. We've got this clear pattern of lower highs and lower lows, and it just remains a very treacherous place if you're looking to be bullish. So let's take a look now at the Russell 2000. The Russell 2000 clearly broke hard through that level near the 50-day moving average. This market was down 4.3% here today. Now we've got to look at that 71 area as the potential level of resistance. Of course, the bigger picture, 76 level, is really what we're going to have to work on over the next year, 2 years, who knows how long. But the market, when it's this badly wounded, is going to take a lot of time to heal. And obviously, the government can't offer up all the solutions. So you can't look at this and try and pick bottoms in these stocks that are just in a free-for-all. As we saw with Lehman Brothers, where there's smoke over here, there's clearly fire, as now it's 21 cents, and the devastation just continues to ripple throughout the entire financial sector. If you look at the financials, it's amazing that the XLF is actually held up as well as it has. The key level we've been looking at for the last 7 or 8 weeks was this $19.75 level, and we broke through that, obviously, nicely here today. Now it looks like this market probably ought to go down and retest these lows at a minimum. The weekly time frame, we still see a very badly wounded market in here. Someone had asked, now that we have a 50-day, the 10 above the 20 above the 50-day moving average, does that indicate a bottom? And it indicates maybe the bottoming process, but from a longer term perspective where these markets can really rally from, you have to look at the weekly time frames. And at a minimum, we're going to need to see these trend lines broken, the markets go back and forth above and below, and the XHB is really a good indicator of that, because we had seen that this group, still a lot of people are looking at, hey, that was the bottom, and perhaps it is, but it's really stuck. This is the home builders XHB. It's really stuck back within this bigger range, and it's expended a lot of energy recently getting up towards this level. So bottoms are a long, difficult process. They're not an event that occurs with a takeover here or there or a rescue plan from the government. Unfortunately, they just take a lot of time to heal, and meanwhile, the best bet is to just be very cautious, to day trade and manage risk in here. Let's take a look at the semiconductors. They weren't actually, I don't know what's wrong with my screen there. The semiconductors were only down 1.9%, and they closed above where they opened, but clearly they were still down 49 cents or 1.9%. This group remains badly damaged in here, and still thinking that these lows, or this level at a minimum, is what I was saying last week, and here we are. Maybe even down towards 22 is where it looks like this market continues to head. Picking a bottom is a very difficult task. Perhaps we get a trade this week, maybe above the $26 level, but it looked like maybe it was setting up for a bounce. But as long as that 5-day moving average is declining in the intermediate term, meaning 1 to 6, 7 days out, you want to look at the market as guilty till proven innocent. The Nasdaq wasn't down quite as bad on a percentage basis, but obviously there's nothing bullish on this chart. Massive volume, down $1.35 or 3.1%, and really what really led to this, a couple weeks ago, was the breaking of this little symmetrical triangle pattern that we've been looking at. We could look again at an estimation of where this may go by taking the height of the pattern, which is about 50 or so, down towards this level here, and subtracting it would indicate a level down near about $37 a share. That's not my call, but it's definitely a possibility and something you have to be aware of. If we look at a weekly time frame and put some Fibonacci on here, we could take these 2006 lows, and we can see that we've clearly sliced through the 61.8% retracement level. And if we look at the monthly time frame, what we can do is then go, let me just get the scaling correct, we can look at the lows from 2002 and measure up towards the highs of last year. We found support once at that 38.2% level. A 50% retracement would bring us down towards that $37. And again, that's approximately the height of this pattern in here. Now, 37 isn't going to occur overnight, but you can look at these markets and look at the devastation in some of these other groups and see that it's clearly believable that that could happen. We have a declining 10, 20, 50, and 200-day moving average. This market remains guilty till proven innocent. There will be bounces. Those bounces should be traded, I think, only on a 1-minute time frame. When the market broke this daily VWAP in here today, and I had posted on the blog a couple times that it was holding in there, but when it clearly broke and made that lower low, that's where the sellers really picked up in here. It remains dangerous. I hope you're doing better than most people in this market, and again, just continue to manage risk.